Hello and welcome to MoreTalk. It is Thursday, 2 p.m. Eastern,
And it is 11 a.m. in Southern California.
and today is another exciting opportunity for us here at MoreTalk as we have two higher up C-level at one of the largest lenders in the mortgage industry. And I think what's very special about this one, Mike, is we have it in the full life cycle of a mortgage, which is the first time I believe we've had it on the same show. So you have retail, where a loan is originated or where a consumer goes in and buys a home. And then we also have representing after it closes and you get the money and you get the key and you start making your payments in this new wild, wild world we're in. How is your mortgage company servicing it, collecting payments, communicating with you? So I am excited. We have Paul Akinmade on the strategy side of CMG. And then we have Courtney Thompson, who is a huge name in the industry on the servicing side, both representing CMG Financial. So
We're very blessed to be able to get both sides of the coin, I think, not only from an origination standpoint, marketing standpoint, but servicing. This is definitely a treat for our show and our listeners.
So Paul, how you doing today?
I'm good. Can you guys hear me okay?
We can hear you great.
Yes.
Appreciate you coming on here. How is everything going at the world of CMG? You want to tell us a little bit about the company before we dive in with both you and Courtney?
Yeah, sure. So CMG is a private IMB. We've got a single owner. We've got multiple channels. We have distributive retail, wholesale, correspondent, a broker-dealer. We buy MSR, and we also have 7 joint ventures. So very, very busy is the best way to put it. And we're very lucky and very fortunate.
How do you handle all those channels, and what right now in this market with maybe rates higher for longer, which last year at this time was date the rate. So you got to be careful on the sayings, right? But in this market here, is there a certain channel that is higher on the focus than the others?
Honestly, I think it's equal across the board. We got really, really great leadership in each one of those channels. Our distributed retail, though, has had the most growth. So it's probably the one that's been thriving the most. We've really, really focused hard on making sure that we're giving our loan officers competitive advantages with respect to how we go ahead and decide on what markets we're going to focus on, what products we're going to focus on. And outside of the products, making sure we've got good delivery mechanisms that allow them to wow, excite, and entrance both their consumers and their partners.
Yeah, I saw a graph that showed in this market, CMG is up 20% in volume, and then the other top lenders were minus. And I'm a sports fan, so I just thinking like plus minus minutes and why that's such a great stat. But you could look at other stats like points. But in this particular piece, there was some large volume hitters, but they were minus year over year for last year. To me, that screams you guys are an outlier. Is it just how that graph was maybe set up, or do you feel like you guys are further or outpacing the competition right now on increasing? And is that just from acquisitions, or is that from some origination piece you can share with us?
What I would say is we've had a few acquisitions, but we've had a lot of organic growth outside of the acquisitions. We've wanted to be in a position where we're trying to have tools, platforms, and products that top loan officers look at and say, hey, that can help me grow my business, and this can help me defy the current market curve. So I think if we continue to focus on that, we'll attract the right type of talent that helps us grow as an institution. Our current loan officers haven't all had the same decline that others have had. In fact, we have a lot of loan officers who are doing more this year, but they're really focusing in on the products that give us competitive advantage, that have platforms to support it, that create opportunities to approach new markets and new customers and new partners.
We focus on this show on the possible long-term disruption of the industry being so heavily invested on GSE loans, and then the mechanisms of even your PPEs, bringing that data out there to the public where it could be disrupted easier than before when the lender knew their own guidelines and adjustments and overlays. And now it's just so public, the GSE becoming so commoditized, maybe not today, but down the road. Hopefully we're doing the show still years from now. But when you say you have products, do you have an example of a type of product a loan officer that's maybe looking for a new company or a new shift in their own business plan should be thinking about when they hear new product? Or is it just a different way?
Sure. No, by all means. So I think when I kind of conflate products and platforms, right? So, but I'll kind of run through that because from my perspective, are you able to help more people in more unique ways than everyone else? And that's really what I try to focus on with the leadership here. So if you look at one of our legacy products that differentiate for us, it's the all-in-one loan, right? So that's your first lien HELOC, where you have the ability to do things like a non-owner occupied loan with bank statements for a first lien interest only to different types of borrowers and different types of partners who are looking for ways to help their clients get that type of financing. You look at our platform, Home Funded, we're the only lender in the nation where you can crowdfund a down payment and also use shopping rebates to help go ahead and grow a down payment and or grow an amount of cash that can be used to buy down a rate. Either way, you're helping a buyer agent qualify a buyer and nurture that environment. And you look at our list and lock program where the listing agent or the seller can go ahead and take out a lock that we do a below market average pricing on with a concession, and we built a marketing platform that generates personalized videos, social posts, websites across the board that allows you now to go and approach and help agents differentiate themselves in finding customers. And we have the same thing for builders. So I think when you look at that, we're able to go ahead and take buyer agents, say, give me everybody that's not ready to buy today. We nurture them for them, tell them when they're ready. And when we go to those same agents, we can talk about ways for them to expand into getting more listings and so forth.
Paul, that's super exciting. We've talked to a number of independent mortgage bankers on this show, and they're specifically their leaders, and they've been talking about staying in their lane, whether it's one company's concentrating on USDA, another one doing govies, and it sounds like that you can establish each branch to stay in their lane and still have a number of suite of products available to them. Do you encourage them to go do it the CMG way and utilize everything while staying in their lane? And then I have a follow-up question to that, but I want to, let's just focus on that first. I mean, is there a CMG way to do things when utilizing that suite of products, or is it only specific to each branch or region?
Well, no, it's not specific to branches or regions. I think it's specific to the individual, right? So a lot of people are good at different things, right? So if you get something somebody's really good at and they're confident in selling, they're able to find a way to scale that. So I kind of joke that depending on the type of lender, you're either a Chipotle or you're a more diverse one like the Cheesecake Factory. So I consider us the Cheesecake Factory of lenders, where not only do you get different dishes, you get different genres, you get different countries. So if you like Italian, go eat Italian. If you like Asian, go eat Asian food, right? So loans are the same way, I think, when you're looking at that. And by having that diversity, it allows our loan officers to cater to various types of referral partners, whether that be what their focus of business is or even just what their main line is, right? So I think from that perspective, we want our LOs to be educated and we want them to find what works best for them. And we want to give them as many choices as possible to figure that out.
That's amazing. And you guys are doing a great job of doing that, especially based upon the numbers so far in market share. And as you guys are doing that, I want to be able to ask this next question as the follow-up. So how are you guys going to utilize this purchase of market share and in conjunction with servicing, not only in customer retention, but also how are you looking to improve the borrower experience? So not only do you retain them for future refinances and also future referrals, because, you know, if you have a Chipotle customer, they're going to come back over and over again because they love their product. And if they like Cheesecake Factory, they're going to come back over and over again. But I think that without the continued advertising or the continual touches by the originator, which is an industry-wide problem, it can be remedied by continued coordination with servicing. So how do you coordinate with Courtney or that department so that you can, now that you're growing by above and beyond by everybody by 20%, how do you maintain that? And either of you can answer that question.
Yeah, sure. So I'll take the first stab at it and then I'll kick it over to Courtney. But I think when we're looking at the customer journey, right? So the industry does a really, really good job of coming up with technologies that are between the application and funded space. There's a million fintech providers playing in that POS market. But when you look at the early nurture stages, I don't know that there's somebody that's there, right? And when you look at the post-close stages, there's not somebody that does a good job there. And there's nobody who has it all tied together. So that's the digital journey we're going on, is to try to find a way to take those three different life cycles, merge them together into one experience, and keep the loan officer in front of that person the entire time. Now, the good news is, as we continue to grow our servicing book, we have a a more engaged way to maintain a relationship. But because we have that as well, we have an opportunity to go ahead and stay in front of that customer with enriched data, with different types of offers. We've even built our own pricing engine to make sure that we can take the delta between the servicing balance and the AVM with where the credit is at, with where revolving debt is at, and start making offers live. And we arm our loan officers with that information. So I think not only is it our responsibility from a digital perspective to stay in front of those customers, but we want to make sure that we can make data actionable for our loan officers to go ahead and maintain a relationship and tell them when it's a good time to follow up versus them trying to go ahead and stare at a giant Excel sheet and figure it out themselves.
Yeah, I'm still trying to figure out how I have Chipotle for lunch and Cheesecake Factory for dessert, to be honest with you. Chipotle's good. Probably you should change that analogy and maybe say like McDonald's or something on the front end of that. Anyway, the servicing part of your question, Michael, is really the reason why I'm at CMG at all. Chris and Paul were really interested in completing the mortgage life cycle, and they were really willing to do it the right way. And I think that that's really interesting. There's a lot of people in the marketplace who are interested in servicing and setting up new servicing, and they either take the, out of the box option from the Dark Lords or the Ice Knight, or however you want to frame that entity in 2024. Chris and Paul were uniquely interested in building servicing the right way the first time, the ground up. Really, as we talked about it more over a long period of time, actually, we talked a lot about how if you set up a data program in servicing the right way from the beginning and you centralize your operation around that data environment, instead of around a 70-year-old piece of technology that, updates overnight, magical things can happen, right? And magical things can happen with the life cycle of that consumer. And I think that we are in a sprint to establishing servicing for CMG. We are looking forward to having loans within our control and within our consumer experience that we're building custom to the CMG mantra for handling customers. And we couldn't be more excited about that. I think that an important component of that and that strategy is really using the best that is available, italics on available, in servicing technology, and really trying to assemble that smarter to avoid on the front end the crazy fragmentation problems that we have across mortgage in terms of jamming solutions into old infrastructure.
The whole servicing piece is so interesting. Hi, Courtney. Great to have you on. Excited about this. I see in servicing the MSR price, people want to acquire it because they think they've now mastered better ways, at least these bigger servicers, ways to protect the people they're servicing. For the person listening out there, that just means they think if they service your loan, they have a good shot when you go to get a new one, that they actually have the power to keep you staying with them and not with the loan officer that you might know or go with. Do you see that's through technology of what the consumer sees, or do you think that's more back office ability to alert a loan officer when to reach out at different times?
There's many answers and many layers to your question. If you think about servicing as what servicing was originally born to do, right? Getting back to basics. It's making and taking, or taking and receiving and applying payments for pity en masse, right? And a lot of this processes, the regulations and other things that have developed over the years in mortgage servicing are really associated with managing that asset, and then post-Dodd-Frank, telling the consumer about managing that asset. But there are very few people in the mortgage industry, when they're thinking about servicing, they're thinking about what I would consider not mortgage servicing at all, which is the entire consumer management and customer service ecosystem around not just communicating with the consumer at the bare bones minimum that the regulation requires, not sending the consumer long letters in the mail with a bunch of legalese written by kids with backpacks in Washington, although they serve their purpose and we love the kids with backpacks in Washington. It's really, how do you talk to a person about a mortgage? The most important investment the majority of folks, ever make. How do you meet them at the road with regard to whatever the heck they have going on today? And how are you going to build that rich customer service layer around this thing that is mortgage servicing, or on top of this thing that is mortgage servicing, and really treat that different? And I think that there's a lot of people that have been thinking about it in the context of just digitalization, or we need a customer portal, or we need a, this, that, and the other. And I think that CMG is different insofar as not only does it support diversity of products and diversity of the growth of business of loan officers, no matter what they might do, it really does think about individual consumers in a way that I have never seen before, in a way that the standard itself scares me as a mortgage servicer, but in a good way, right? Like the exciting kind of scaries. And at the end of the day, we really want to break through that which is traditional servicing, which is necessary and it has to be done, but we want that to be blocking and tackling so we can really focus on what is a note, what is a mortgage, what is a recast, what is a mortgage service transfer, how do I get there, how do I set this up, how do I have to not talk to a person, right? We have a lot of fun late night conversations these days about how do you create an call center in 2024. And I think that that will be the CMG difference at the end of the day, when we're really able to, manage our retained loans the right way.
So then I've often thought about how consumer direct really can play a more critical role in conjunction with servicing. Then is there some kind of future for that in your sprint to provide better servicing in your product and the customer experience, or the borrower experience, I'll say, borrower and customer being the same, while also servicing CMG as under paper as well?
I would say a couple things there, right? So one of the things I think that's unique with us is we want to make sure that we're arming our distributed retail loan officers with their tools to service their customers. So when we're looking at how do you have a good relationship, you already have an advisor as part of that conversation that's available. So we want to make sure we give optionality to the people that we're servicing to say, hey, who would you like to talk to, right? So if you want to walk through an escrow assessment and you have a question about it, you've already been asking questions to your loan officer. Maybe that's a good opportunity for you to go back to them. And then the thing is, are we signaling that loan officer, hey, this person also qualifies for the following on that exchange? Now, obviously, that's only for customers that are current and we have to have guardrails up and all that. But I think from that perspective, there's an opportunity that a lot of people don't quite think about, is that, hey, how do you maintain the relationship of the originator that originated the loan throughout the entire journey of that customer? Now, obviously, when you don't have that prior relationship, a consumer direct call center environment works really, really well. There's been companies that have done great jobs by making sure they're using data in combination with technology to move people into not just respective buckets of opportunity, but ones where we can address other needs that pop up in advance of them having any type of problem. So I think the opportunity there is to make sure that, one, you've got your data right and you've got your technology in place, but you're leveraging the relationships that already exist that the customer is already comfortable with. And Courtney, I'll kick it to you to see if I said anything wrong there.
No, I mean, I don't think any of it is wrong. I think that there's an interplay, right, between making loans and taking care of people that is a really empathetic and important nut to crack, right? So it is everything Paul said, and I would say, and Paul, we are in an improv game now. I'm just going to say yes and to whatever you say, a la Amy Poehler on Delta right now. If you're flying on an airplane, please watch it. It's amazing. In mortgage servicing, people on the phone are trained to ask, the QRPC questions. Why are you delinquent? Do you intend to keep the home? These are not friendly things to talk to people about when somebody's having a bad day and they lost their job, or, whatever the case may be. Really being able to engage the consumer in understanding, I would call them the milestones of life, or the things that they are experiencing that might also help us connect those consumers to new products, new opportunities for credit, different products, different times, different lives, right? That's where, by investing in data management in the way that we are, we're going to be able to not only just trigger our LO base to reconnect with Molly, because Molly's pregnant and growing out of her house right now, per the conversation that we had with her on the phone this morning, right? But we're also going to be able to help identify, assets within our portfolio that maybe don't have an LO connected to it, where we can really bring in our DTC team to help there. And I think that a lot of people are trying to do this, and a lot of folks in the industry are doing this retroactively, whether it's data management or whether it's really understanding the consumer and consumer behavior, right? They're looking at this 60-year-old data set that they've, enhanced over time, and how can I use this to do these things? And everybody can tell that I'm excited about being able to think about the consumer as a human in 2024 and not in 1968 when mortgage servicing tech was created, and do better, right, with regard to understanding that customer, who they are, and how they deserve to be communicated with.
So how do you think a customer borrower experience needs to be communicated with? Paul alluded to a few items of how the originator can maintain that relationship. But I think there's a lot in the sales coaching space of saying, hey, you know what, have your assistant do this, have the originator do this, and delineate what those duties are. Do you guys have some communication yet? Because this is still a very new space in the servicing and retail originator space on trying to communicate with each other. Is there some kind of system yet on how those two partnerships can be increased in their communication level so that the after funding or post funding, the borrower can not only have a better experience and really stay on top of their personal finances and then come back as a future buyer and a future referral source at the same time?
Well, I think when you're looking at that, it's going to be a little bit of a blend, but I think having the right type of tools and technology allow for that blend to occur. So it depends on who's initiating it. Are we initiating it automatically through our systems? Are we allowing the LO to initiate, or is the consumer initiating? So something that we built that we featured at Digital Mortgage was our opportunity pipeline, meaning that we take all of our entire servicing book. We went ahead and ran AVMs on it. We ran credit on it. When I ran credit on it, we went ahead and took a look at what the total revolving debt is, total revolving debt payment is, and then we went and built algorithms that signaled various things. This person qualifies for X amount of cash out. This person qualifies for a debt consolidation. This person qualifies for a reverse mortgage. This person should do a HELOC. And it took into account where their current interest rate was. We built our own pricing engine so we could establish a par rate that was unique to the loan officer. Now the loan officer can just log into a dashboard and sort by various types of opportunity flags based on the maximized opportunity, i.e., highest savings, most cash for least amount of payment effect, and stuff like that. So that's the driver that's coming from the LO side. That one, from my perspective, gives them a great opportunity to make data actionable, right? Now, when you're looking at the consumer and them driving it, one of the things that I look at is the difference between a distributed retail loan officer, as you mentioned, that may have a processing assistant, or a distributed retail loan officer that doesn't have a processing assistant. Because we're building a consumer direct model as well, too, we want to make sure that's a supplement to help the distributed retail LO who doesn't have a processing assistant to go make calls for them, facilitate those calls. So that then we have to make sure that we segment our group and let them opt in, meaning that they get to choose their own adventure. I want to call all my own customers and leverage opportunity pipeline. I don't have time for that. Please do it for me. And I think when you're allowing that type of optionality, you're allowing people to kind of choose the space that they want to live in and the type of environment they want to grow their business, right? In addition to that, from the customer driving side, having really good marketing that takes those opportunities that I just talked about, packaging them up, and actually soliciting offers to the consumers, right? We're testing that today for our customer base that currently isn't attached to a direct distributed retail loan officer, but we're doing that to make sure that we get it right. So when we turn it on and stick the loan officer's contact information in there, all the right signals are triggering the way that we want them to, and they're going ahead and helping them bridge that relationship gap that may have not existed since the time they closed the loan a few years back. So that's how we're focusing on it, but it's a multi-pronged approach, and you're not going to have a silver bullet. You need a Gatling gun, unfortunately. So that's how we're trying to attack that.
Are you utilizing Byte for that? I know that in Encompass, secondary and retail can communicate to some extent. So how are you communicate this? Is this through a CRM? Is this through Byte? Or how is that communicated?
So it's funny because it would be great for me just to call out a vendor and say they did an amazing job at this one thing. But we built it ourselves. We partnered with the technology firms to get the outcome that we wanted. When it comes to actual delivery, we use Salesforce for the delivery of it, but we just tell Salesforce what to send. So we actually had to build our own data layer that manages all this. So the nice thing is we have a lot of really smart people here at CMG. I run the data team as well as the marketing team and technology team. So getting everybody to kind of coalesce around one initiative is one of the things that we've been able to do relatively well.
That's great. And here we're at the bottom of the hour. So we just want to point out real quick, if you're listening on Spotify, please give us a follow and an alert. We have some great IMB leaders coming up here throughout May and June that you will want to at least be alerted throughout your weekend. All of our podcasts drop on a Sunday. So while you're out and about, you can listen to great shows like the one we have today, or we are also on a YouTube podcast, which is now the official podcast provider of Android phones. And we're looking to enter the Apple podcast market soon. But the way we can do that better is you giving a subscribe below. We also, if you subscribe to our YouTube station, and you're on it right now, give it a like, but give it a subscribe because we have the mic drops every Monday, which are videos of our guests recapping their own show. And it's edited in a really fun way for you to consume and understand where the market's going. So jumping back into what we were talking about, I have a question for both of you to answer. And this one's a little bit more raw, so you can tread lightly if you'd like. But I think one of the issues here in mortgage, and it's really in line with what you were saying, is we all have these great databases now where for the last 10, 15 years, mortgage has done a very good job of getting data involved. It might be older data, but I find DTI and LTV at point of closing has relevancy. The problem is it's $13 trillion being serviced. 70% is, quote, golden handcuff now, below 4%. And then you have $26 trillion of equity that you can see a lot of that in the database. But loan officers have a really hard time having conversations around it. And I believe in the Tapper rule, which is the jump from 30% retention after a second visit to a third visit, which goes up to 70% retention and referrals among friends. Doing 3 first-time refinances now moving forward, I think is going to take too long. Whereas if you started giving equity products, whether it's an HEI, HEA, or the new HELOCs that already exist, or the new ones coming out that Freddie Mac and Fannie Mae now want to be involved in because they don't want assets to deteriorate here. They need people to take cash out. Equity used to solve problems and create opportunities. After the financial crash, they are seen as problems because consumers don't know how to use, will overuse them or overspend on them. What are your thoughts on help homeowners tap their equity while still maintaining that idea that we're helping them and not hurting them by giving them access to it?
I mean, I think that at the end of the day, all we can do is, or lead a horse to water, lead a horse to drink. Paul, why did you make me go first? All we can do is provide the consumers the information about the product, how it works in conjunction with the interest rate on the product, and do it in a way that is clear, accessible, digital, potentially in multiple languages, right? And I think that where the gap is, at least from a consumer education and consumer communication side, and I'll let Paul take the fancy finance side of the question, is meeting the consumer where they are in 2024. The predominant source of communication to consumers about loss mitigation in 2024 is still the U.S. Postal Service. We have to do better in the servicing community. We have to do that better in the mortgage lending community as well. Digital closings, I mean, adoption there is still terrible, and everybody is still scratching their head, even though states, right, continue to adopt remote online notarization laws, and things like that. I think that this would be less of an issue if we weren't all still living in 1972.
And I think the mailbox is the only one that I'm one of those 78 million rising people out there. And I can't tap the equity in my house through what I get in the mail, which is the local bank saying get a HELOC. And the loan officer's not calling me, and my portal for my servicing isn't talking to me. But I know there must be equity-driven resources out there for people to be having conversations with me. Is it they just don't get paid enough to talk to me?
There's that piece, and then there's one other thing, and then Paul, I'm very sorry, and you can take the rest of it. The other thing that we're not talking about, which is maybe the giant elephant in the room, or what is a really big, nasty creature, T-Rex, short arms, is the fact that most of the loans in today's marketplace are managed by sub-servicers. Sub-servicers don't give a ding-a-ling, right, about that MSR owner's ability to ... They say that they do, right? And potentially there's some creative relationships out there where they're incented to. But these are still servicers that are working out of 482 systems and communicating in paper, let alone, understanding or investing in the data that's available to communicate with these consumers and to grow their portfolios, right? And I think that that is the interesting thing about CMG or Freedom, right? I think Stan's probably doing a great job of this, right? Where if you're managing your own assets, you care about them in a different way, and you're able to creatively think about how to engage those consumers in the long term and maximize the use of that equity nugget. Paul?
Thanks, Courtney. So yeah, no, I think when I'll address a couple things because a couple things were said, right? So first off, CMG, we wouldn't be the Cheesecake Factory if we didn't have various forms of second liens, right? So HELOCs versus closed-end seconds, right? I think that the next thing that you said which was interesting, is are they not getting paid enough to do outreach? Going to a customer and trying to help them with $30,000 of equity, you need to have them either reach out to you or you need to know that they need help, right? So that gets back to the data, kind of where I started, right? So from my perspective, if I know that this individual here needs a little bit of assistance because they have a revolving debt for that purpose, and I signal to both the individual and both to the loan officer, hey, make a connection, I have now helped them establish that need. Now, the difference becomes when you're trying to tap equity and you've got an amazing rate. If you don't qualify for a HELOC, that's one of the really rapid ones that can be done instantly. You can go through the manual process, or you can do the closed-end second, right? Now, that process likely needs to be driven by the consumer or by the organization's systems to go ahead and push that out there. Because again, as I said, you want to make sure that a loan officer is able to do the right type of outreach, because in many cases it wouldn't be relevant, right? So we want to make sure that we're giving relevancy to the conversations, and that's what we focus on there. Now, with respect to, let's say, somebody who has a high amount of revolving debt, and their interest rate maybe is not completely golden handcuff, let's call it silver handcuff, they're in the fives, right? You've got $60,000 of revolving debt and a $300,000 loan at 5%, but you're carrying out 0.5%. I promise you that even in those scenarios, you may find an opportunity and a need for cash out for somebody who even doesn't qualify for a HELOC due to a lower credit score, because they have the ability inside of their equity to go ahead and have a lower LTV and still qualify for a loan. So I think it's all how you arm your individuals and how you are using data to identify and make actionable opportunities for all the parties involved.
So utilizing that data, I was looking at some numbers from the New York Fed earlier this week. And number one, consumer credit's increasing, and inflation obviously has reared its ugly head. I'm going to say this more as a post-funding question, because the cost of insurance is increased. Property taxes in certain states are increasing faster as a result of the increasing values. And so when it comes, the budget may have been at 41 or 42% debt to income ratio at funding 2 years ago, but now the cost of living plus the cost of insurance plus the cost of other taxes and increasing costs are now throwing those post-closing ratios out of whack. And so now it's no longer now the W-2 employee who's funded that mortgage loan may have had that budget, may have gotten an increase in wage through cost of living adjustments and so on and so forth. But it now becomes a servicing issue if the cost of living is becoming much more expensive. So my question is, how do you treat that, number one, at the retail level, so that you can get that customer again? Maybe they need to do a downscale, but the rates are higher, so they have to go for, to a lower property house or whatever. And then how do they work with servicing for, to deal with that in the event that it becomes a financial strain?
Well, I'll let Courtney do the servicing one, but it was funny. I went to an amazing event recently, AmeriCatalyst, and they talked about that very same thing. And immediately afterwards, I wanted to pull data because I wanted to see, with respect to where our book was, I was going to make my own index. I was going to name it after myself, which was going to be the delta of the PITI increase minus the average wage for that market. So I ran my analysis, and I was looking for a high correlation on defaults, historic and current. And what was funny, when I looked at the growth of the average income, and again, I was using the AMI, area median income, to see what that growth rate was by market, I wasn't seeing a huge thing that jumped out at me, and it surprised me, right? So I was actually shocked because I was anticipating I'm going to find a bunch of people in California who've been made to go to the state insurance, and it's going to go ahead and jump their PITI by 40%, and I'm going to see a correlation of defaults. But the interesting thing is, because of the low unemployment rate, I do believe that we've actually seen wages somewhat keep up. Now, obviously, market by market, you're going to have various arbitrages where that's not accurate, but in the aggregate, I was not able to find a tight correlation that was statistically significant, which was driving me nuts, to be honest with you. And in many cases, which really threw me off with the wage growth in markets where you didn't have those extreme changes, the DTI delta went down, right? So I think when you're looking at that, yes, if you were going to go ahead and refinance that individual, the cash, the the interest rate, if you did it in the last 5 to 7 years, is likely going to be one that's not going to be achievable. But if you have outside factors that are applying, call it financial pressure on you, like revolving debt, because of, let's call it the inflation of everything else, then there's an opportunity to still help that person lower their average monthly cost, reduce risk on the loan because they're not carrying it, and still position the person to have a really, really good outcome down the line and still qualify. So I think there's a lot of factors there, but it wasn't as much as I was anticipating. And Courtney, obviously, this is your world, so I'll kind of kick it to you to see if I said anything incorrect.
No, I don't think that you said anything incorrect. I particularly liked the shout out to AmeriCatalyst. It actually was, I mean, in terms of content, I haven't been to an event like that before, and my mind is still reeling with all of the, different things that, Paul, we've been jamming on in the last couple of weeks. I think that, again, being a conduit to homeownership in any part of this industry is an enormous responsibility, right? And of course, times are tough, particularly in the mortgage sales world, and we want to make loans. That's part of the business, sure, right? But at the end of the day, I think that, we have to be conduits of the truth and what the circumstances are. And we have to take the time to educate the consumer about what these things mean. Do I think that means that if you are educating the consumer about buying a property on the beach in Malibu, you should maybe have a conversation these days about the cost of insurance and the fact that the house might fall in the water? Yeah, maybe, right? From a servicing perspective, once the loan is made, we are limited in terms of how we can how we can help the consumer, at least with the solutions that are available today. But having the same ability to synthesize the information, come up with the right offer to the consumer, and be proactive by monitoring payment history, monitoring what we've been calling payment shock, right? For things that educated people should reasonably anticipate in the marketplace is probably the best that we can do there, right? I do think it's about education at the end of the day. We cannot be responsible for ensuring people's decision-making, but there is a responsibility there.
When you say responsibility, does that mean to the originator they're salespeople at the end of the day. And if a person's going to buy a house, then they're going to buy a house. So is the responsibility fall upon the education at the retail level, or does it fall upon servicing to educate the consumer saying, why did you do this?
I think that's a really responsible question, Michael. And I think that the answer is both. I think that organizationally, we have an entire initiative as a part of our servicing project about how to educate the consumer at the closing table about things that may happen with regard to your loan when it is serviced by CMG. Now, we've had a lot of conversations about how to make that stick with consumers because, the last thing that somebody needs is another piece of paper to sign at the closing table and not read, right, until later. But I do think that, and I was thinking about this earlier when Michael was asking Paul about, how to maximize the direct-to-consumer channel and other. At a lot of other organizations, you see each of these lines of business, sales and different divisions of sales, DTC, secondary markets, servicing. Sometimes servicing is bifurcated depending upon what institution that you're working on or with. And all of these channels are operating under separate P&Ls. And I think it's one of the reasons why just functionally at big organizations, it's very hard to pull these things together. People are incented differently, right? But one of the things that Paul and I have been charged with on behalf of CMG is to really complete the circle of homeownership and really think about that experience holistically, because the better we set up a consumer when they're at the closing table to understand how that loan is going to operate, whether the issue is climate change or the issue is they're building a new home in Texas, and be backwards in Texas with regard to taxes, levy Texas. I do think that that's our responsibility now. And I would encourage sales folks that are listening to this to know and understand more about this and be the person that educates consumers about this, because I promise you, sales folks are the first one to say, hey, Courtney, it's your fault I have a bad Google review, right? But at the same time, I see that as a symbiotic mutual responsibility to make sure that our customers are taken care of. And I will show up to that road. And CMG will show up to that road with regard to the customers that are flowing into our new operation.
Paul, I'd love to hear your response on that.
So I think from my perspective, the question I would ask is, do you want to be an order taker or do you want to be an advisor? Right?
Yes.
So I was an originator. And I think that one thing that's really cool about CMG, and it's probably the reason why we think about products the way we do, is Mr. George, our leader, he was also an originator, right? So when you have that originator mindset and when you've been a high producing originator, you think about yourself as an advisor, not somebody who is just a rate shopper, right? So I would say it's no different than me talking to you about what it is, how long are you going to be in that home, so I can establish if it makes sense putting points on the loan or not, calculating your break-even point and letting you make a decision that says, hey, if you went ahead and paid down this loan, you get this additional cash. If you reinvested this cash, here's what your rate of return could be. And this is why you would buy down a loan. You don't want to do this if you're going to plan on moving in the next 5 years, right? So, and your break-even point is 6 years and 7 months, right? So that for me is the advisor piece of it, right? Now, no loan officer wants to go blow up deals by going ahead and telling where the customer goes to realtor and says, hey, Paul said that I shouldn't buy my house in Malibu because it's going to fall into the water, right? But I think it wouldn't be a bad thing if Paul sat down as an advisor and said, hey, the insurance rates in Malibu have increased by 40% year over year. Your DTI is 46%. While you qualify today, this could stress you out later. What are your thoughts of buying this down a little bit? Or why don't we see if we can counter with a higher offer and apply some of that to points? And let's buy it down with 3 points and make your DTI cushion go to 42%. So that way you can better absorb that. And then you can even put cash away in case it does go ahead and creep up on you. That's the difference between an order taker and an advisor. And I think that when we're at CMG, that's who I want to make sure that we're supporting, who we're nurturing, who we're growing.
I love the vision there. And in our spin-off show where we try and predict which houses will fall to the ocean is a great listen. But awesome. I love your vision. And back when I was a loan officer, you know, we all went to school for finance, and our view of an advisor was really like what total cost analysis does. Financial advice, like you should be here because of the amortization schedule, shows you interest. I think the world's changed, and maybe it's just because I'm immersed in technology, but it's such an experience world, and like what kind of experience you can give, and with rates that won't just keep going down now, like I said, less ways to reach out and give. You're going to have to really embrace how your servicing is and what their experience is and why they should use home ownership to build generational wealth, and all of the reasons they should reach back out to you because you have advice for them all throughout their lifetime. And I think you guys leaning into that, I could see why loan officers are attracted to that. And I can't wait to hear more about you guys doubling down on that, because when I was originating, we weren't talking about the servicing. We just assumed it is what it is. But Courtney and the rest of the groups, kind of going to get, new software coming out against what was only like one place you could go, shows that there is going to be better experiences ahead. And I have no doubt you guys are going to be on the cutting edge. That wasn't really a question. That was just a bunch of flowers your way.
I like flowers.
Do you guys have anything you'd want to lead with or tell, the audience, which is typically loan officers wondering, how they can build a future in this industry? Maybe it's through more borrowers, or maybe it's through a career path, differently within the mortgage industry.
Yeah, I think the only thing I would say is be informed, right? So obviously, I think we've built something that's pretty cool here, right? But don't be complacent. Assess where you're at all times, whether you're at CMG or whether you're at another company. Make sure that you're getting the tools, the support to grow your business in a way that is actually moving in that direction. So that would probably be the thing I would lead with, is just make sure that you're informed. So go do your research, do assessments. Sometimes that initial investigation, that work, while it seems like it's tedious and nobody wants to do it, it's like going to the gym, right? It may position you to have a much smoother runway for years to come. So that would be the only thing I would probably finish with, Michael.
That was too good to riff off of. So we'll leave it with Paul's comments there. Yeah, I mean, I think personal responsibility is always a thing, right? And I couldn't agree more.
Yeah. Before we end this out, there's something that I thought was really interesting last year when I was at the California Western Secondary Conference. There was a breakout session of capital markets there, and it was interesting that At the time, they were talking about the recruiting of retail originators. And in that part, what they were saying is that more originators are actually talking to capital markets to find out about pricing and so on and so forth. However, in this specific conversation, it sounds like that servicing from a customer retention standpoint, a customer service standpoint, and a greater breadth of establishing brand recognition for CMG actually could be a better way rather than asking for sharper pricing. So basically you can line the pocketbooks of originators. It sounds like you can still line the pocketbooks of originators. I'm going to say that tongue in cheek by working with servicing, not only in customer retention, but figuring out how to be a more trusted, valued advisor with the servicing department, as well as all the products that CMG has to offer at that point in time. So that what you guys put together in this particular conversation and in your relationship and managing with each other has been an amazing conversation for all of us to listen to and then re-listen to, so we can figure out it, or other IMBs, if they want to continue that, to put what you've put together in the model to use as an example for themselves as well.
I guess like Columbo, one more question, Paul. Maybe this is for you. Frequent person on this show, Jay Promisco, now president of Sierra Pacific, said last Friday on Rick Rock and Jeremy Potter and Brock's show, which I watch every week, recommend everybody watches it. It's awesome. And he actually mentioned lowest cost provider, you guys specifically, and better. Do you know what it might be that has him saying that? Is there some Stratmore Group article that came out, or is that just a feeling? How are you able to differentiate yourselves as lowest cost provider? Is it because you're on a different LOS that doesn't take 10 to 30% of every vendor? Like, is there something specific you can point to? Or do you think it's just an overall thing?
I didn't know anybody said that, but I guess I'll take that with a badge of honor, I guess. So thank you. It would be where I'm at. So you've heard it here. If you want to be able to give the lowest rates possible in the industry, I didn't say it, someone else did at CMG. But no, I think I don't know that I have a comment to that other than a thank you. I didn't know that we sat in that space. I do think that when I look at costs, that is something that I'm very, very aware at. It can get out of hand. A lot of times people buy technology for technology's sake and hoping that it will get you an ROI and a lower cost of manufacturing. So they'll spend a lot of money on automation that doesn't do any automation, but they're still spending the money, right? So I think from that perspective, a certain level of frugality is important. When we look at different technologies, we make an assessment of, hey, is this something that's going to be advantageous to us? And is it going to allow us to serve more customers, or is it just a new technology? And I think that that's a big challenge for companies to not just have change, right? You need a change where it makes sense and not change everywhere, right? So I think from that perspective, we've done as good of a job as possible. I used to run my own business. So when I'm looking at corporate funds, I try to say, hey, would I spend money on this? And I'm very, very diligent about that explanation to myself before I ask others. And then when it comes into the negotiation, that same type of frugalness is applied there. So I didn't know we had that badge, but I guess I'll take it. It could be assumed just because of our growth. But again, thank you.
Yeah, then I'll add, just from my experience and representing another client, Silverworks Solutions, I'm really diving in and seeing that it's easier for tech, or at least the automation tech, to reduce costs if it's a centralized model. But there is a big lender out there that's not centralized that is known for winning a lot of the recruitment and acquisitions, and so it's catering to try and win that. You go against it. So is there a centralized versus decentralized within departments that you typically have, or do you have ROC centers throughout the country, which should be regional operation centers for the listener? Or are you more of a decentralized, let the branches do it?
I would say we're kind of a blend. We have a lot of decentralization, but we have some centralization. So it just depends on the size of the operation and its locality, right? And you're absolutely correct. When you're in a decentralized model, you need to have similar workflows, right? So when you're looking at automation, we have an automation division as well. We really go in and analyze, okay, how does everybody do it? And at this juncture, can you steer everybody to do it the same? Maybe not end to end, but at that phase, right? So again, you have to be very, very pragmatic about what you think people will do, because if they don't adopt your technology, then there's no point in building it, is where my head goes. So you have to think through, will I get an 80% adoption on this? And if I do get that, how large is the group we're serving? So Things like correspondent and wholesale are very, very easy to write automations to. But when we apply that to distributive retail, we have to be very, very thoughtful about what's the workflow. How does each group have a different workflow, and how do we cater to that group? And will this apply or will this not apply? So those are things that we think through from that perspective.
Great answer. Thank you. And thank you for coming on. We do really appreciate it. We hope all of our listeners give a subscribe and a like so they can hear this. And if you're on YouTube, give a subscribe so you can see the video recap as well. Any final mentions you want to mention, Michael, for sponsorship as people kind of tune out here?
For those of you who don't know what I do, I'm lead underwriter for Arc Family Office. We're single family office underwriting for private investment in real estate, in debt and equity, making purchases of debt and or funding debt in the private space.
Thank you, everybody, for joining. We'll see you next Thursday at 2 p.m. Eastern.
11 a.m. Pacific.